Stephen, we've known each other now, I think, 10, 12 years. A number of occasions we've met up at property investor shows and at other events. But things have moved on from your previous career with Shawbrook Bank.
Yep.
So tell us what it is that you're now doing.
Yeah, thanks, Richard. So now I'm a co-founder with Karen Bennett in a new business called 9Y Capital. So we're a non-bank lender, having kind of been a bank lender. Slightly smaller sort of setup, but serving professional property developers and investors. And a little bit old-fashioned with kind of a relationship-led model. Using kind of the benefit of our kind of lending pedigree, but also some of our own property experience that we now have, and combining those. Which we think gives us a good opportunity to really understand our clients and their projects, and apply good commercial judgment. So, we just enjoy, I think, what we've done in our careers. We're lucky, I think, in that regard to enjoy it. And I love property. I like meeting clients, love looking at the projects, and it's nice to be a kind of a capital provider and do sort of positive lending, really, where you're backing clients to bring their visions through, and quite often repurposing old, tired property into kind of modern, fit for purpose dwellings. So, we enjoy what we do. So we're lucky, I think.
Yeah, I can relate to what you just said in terms of the creation of the end, the vision being realised, and obviously finance plays a very important part in that in order to leverage what people themselves bring to the table.
Yeah, I think it's interesting because I've lent into different markets, obviously, in my throughout my career, and there's mortgage finance, and then there's kind of project capital, and most of the time we're providing 85% of the money really on a project, and so therefore it is almost like a joint venture project rather than as a traditional lender. And I think sometimes investors and developers, if they're used to sort of taking out long-term capital, sometimes don't realize that when you're taking out shorter forms of capital, it is actually a project partnership. Obviously, look, we can provide the capital. Our clients are the ones with the vision often, and the blood, sweat, and the tears, and the creativity to make it happen. And we think we can help with the diligence there as well, and making sure that it still makes sense, because you need a combination of the vision and the entrepreneurship also, but with a bit of, financial acumen as well, and a second look from a more traditional aspect as well. I think it helps a lot of our clients. And there's a couple of projects I can think of where the clients actually said to us, how are you finding the work, and in particular on the property in question. You could see they were relying really on our work as much as what they'd done themselves, which so it's a different philosophy a little bit to longer term mortgage finance, where to be honest, investors are really just looking for as much leverage at the sort of cheapest price because it's more commoditized. But projects, they are more commercial. They do need a little bit more skill and creativity from the lender to match that of the borrower and the clients, really, whose vision is really what is driving the opportunity.
Yeah, I understand what you're saying there very clearly, because just thinking about over the many years of published Property Investor News and all of the developers that I've spoken with, and in some cases watched their journey grow ever relatively seamlessly, but in many other cases we've seen people crash and burn, unfortunately. Of course, they are quite bullish generally. Not most, but a number of property developers can be quite bullish. But from the risk sort of context, as a financer, they can be bullish, but you need to sort of see through that.
You do. I think one of the things that we'd like to think, with the 9Y business, is that we are positive generally as a positive outset. So we're looking to find a way to support the client and support the project, really, rather than looking for ways to say no and trying to sort of find a way not to do a transaction. It's, you are coming in from a point that says, right, is there a way that we can support this sensibly, safely, and for the benefit of all parties? Because there's no point supporting clients on projects, even if they want it supported, if you don't think it really makes sense, because it'll probably end in a difficult position for them ultimately. So they need to sometimes be protected a little bit from themselves. With in all due respect, I think but nothing would happen without the sort of ambition really and vision of these property investors and developers. And it's easy to be the prudent one in the room, but you also need the flair to see, I think, the angles. And
Yes.
I'm sure we'll come on to it, but the market is a much different place today than it has been in the last 10, 15 years, and I think it's much more demanding environment, and it's putting a premium on the skills of the entrepreneurial investor and developer that can still find a way to make it work, notwithstanding it's harder. So
the low hanging fruits sort of to some extent, as you say, you've got to create the deal. It's the skill set, the experience, allied with as the lender, facilitating working with the developer.
I think when you're looking at it from a funding point of view, you're certainly, we feel that we believe a lot in the client as the first sort of stepping off point really, in terms of their credibility, track record, experience. Are they backable? Yes. Again, which is when you go back to the old banking days, it comes back to the sort of the character of the client in the first instance, and so that's our starting point. And I think if you can find those, and there are so many that immediately as soon as you meet them, you can tell this is a client that clearly has proven a model, has been through it, has experienced the good and the bad, and then you go, okay, this is a client that you want to support really, and you're coming from that angle rather than actually being looking for ways not to sort of do the deal. So clients, the client profile is fundamental really for in our philosophy. Obviously the project needs to be commercially viable. Yes. The diligence needs to support it and all those good things, but fundamentally, lending is one of the oldest professions in the world, and the key point is always making sure you back the right clients really.
Before we go on to talk a little bit more, your background in terms of where you come from to where you are today with 9Y Capital.
Yeah, so I guess my sort of starting in my career as a chartered accountant actually. So that was my training, and my initial period in work was qualifying with the chartered accountant's practice. So I was fortunate to do that for 3 or 4 years. And then in sort of my mid-20s, actually, my father had a very sort of distinguished career in residential mortgage lending. So it's kind of, I guess, slightly a family business. And he'd sold a pretty significant residential mortgage lending business. And he was very entrepreneurial. Much more entrepreneurial than I am actually, and he was keen to kind of build something else, and he had various restrictions about what area of the market he could work in for a period. So you kind of identified a gap in the commercial mortgage market. So bear in mind this would have been back in pretty much around 2000, 2001. He was keen to start something and wanted to work together. So there was a team of us that set about building a mortgage lending business, serving kind of SME owner managers of commercial property. So that business was called Commercial First, and set off and lent, I think, nearly 2.4 billion in the end of long-term mortgage debt to SME traders. Owner managers normally, not so much investment led, normally trading businesses. So that was 6, 7, 8 years of a chapter, I guess. We used brokers to distribute the products, and served a market that wasn't really used to seeing a non-bank lender. That business borrowed its money from the wholesale markets and the investment banks, originated mortgages, and then securitized them. And that was obviously a growing kind of route for residential mortgages at the time, but hadn't been done for commercial mortgages. So we kind of took the model and sort of pivoted it a little bit to support commercial property. And then we was fortunate that Lloyds Development Capital actually became a shareholder in that business around 2006, which was helpful because roll forward 18 months and we were into the general financial crisis, and learned a lesson that we had a business built on kind of one sole funding model that overnight was turned off. So like having a shop with nothing to sell, we had no funding. So had a period of just working through the book. Unfortunately, we had supportive shareholders, and then kind of roll forward through that sort of general financial crisis period. And then we had an opportunity to take a part of that business and form a new bank. Yes. So this would be in 2010. And at the time, the only way you could really build a lending business was with retail deposits, ultimately, because the traditional banking channels and the investment markets were kind of closed still. So, so we were fortunate to get an opportunity to build from scratch a new lending business effectively within a banking platform. That bank was a very small bank. It had been acquired because at the time it was easier and attractive to kind of acquire a banking license rather than to go about the process of trying to get a new one from scratch. So there was a sort of banking license there, but it hadn't really done too much. And we had an opportunity to kind of join as a part of the team to build out the business and the business model. So that business rebranded to become Shawbrook in 2011. So I was the first employee of the business, which I'm very proud of. And the first loan we wrote was a semi-commercial HMO. Which I still remember, which was the first loan, organic loan we put on the balance sheet back in March 2011. Then we had a lovely kind of opportunity to build out the business on the back of the crisis, where obviously we were then in a low interest rate environment, which obviously provided quite a lot of ammunition and impetus to the market. My role primarily was building the property business, although I did later sort of join the board as in an executive capacity as when we went through our float. We were very passionate, I think, about building a great business serving really the investor community rather than in the owner-occupier market, which we'd come from. And I think that business has kind of gone from strength to strength and been an important part of the market, I think, for investors over a period. So that I did. So I was there, fortunate enough to be at the business there. We floated in 2015. We were taken private in 2017, and then I left early 18. So I then had a year of actually being on the other side of the fence and did some property investing and developing. Yes. So I kind of manufactured. Well, I say I had some good friends who were very active in the South Coast, acquiring, manufacturing house share HMO properties. Right, yes. And at Shawbrook, we'd, I think, been one of the very first lenders to think quite deeply about HMOs and them as an asset class and as an opportunity for us as a bank. So I was kind of keen on those assets and had a chance to kind of do it myself, really. Yes. So did build a portfolio of HMOs down there on the South Coast. Did some more speculative development. So helped some other kind of people in my network with conversion of commercial to residential, included some grade 2 listed. Did some farm, another grade 2 listed farmhouse actually with some derelict barns, which was fun. Yes. It was really fun actually. Quite eye-opening, and educational really, thinking you kind of understood what clients go through. You don't realise how much you don't know until you've actually truly
Indeed.
yourself. So did that for a year, and then sort of 2019 onwards, was quite keen to go back to my kind of heartland really, which is lending money really, and being a finance.
So you went from gamekeeper to poacher, and then
yeah, back again, and hopefully as a balanced gamekeeper now. That's
with more insight into
yeah, and so since 2019 we've been lending to investors and developers in a smaller platform really, more intimate, personal platform, and we're and have hopefully used the benefit of our own direct investing and developing experience to improve the lending journey really, and become better lenders.
So what are for 9Y Capital? What are typical projects that you're working with developers on?
Yeah, so we're definitely very project focused as a lender, and therefore it's normally some form of refurbishment, conversion, extension, or out of the ground. And normally our facilities will be anywhere from sort of 250, 200,000 up to 5 million. Tend to, I think, if I look at the market, the refurb, conversion, extension market is served by a number of sort of bridging lenders and so forth. And we would be quite active in the HMO and the house share sector. Again, I guess because we've done it ourselves, I think we can look at those opportunities and hopefully make it a bit easier for the client because we understand what they're actually doing. So that's a big part of what we do. In the development space, we would tend to do slightly smaller schemes, so sort of up to 3 million, sort of 6 to 10 units. I think the area of the market which the sort of specialist banks are active but are more focused on larger transactions, and they leave behind a little bit of the smaller development space.
So the 9 and below. In terms of the
that's our sweet spot. And again, for us, they're lovely opportunities. They're good size lending opportunities. For the banks, they tend to be on the sort of the small side of their appetite. So we do think we can kind of apply, and similar to the sort of structures that a bank and the pricing that a bank would apply, but for the slightly smaller developer. Sometimes an emerging developer, quite often we'll be lending to people who have got expertise and experience in conversion and in property, but may not have done an out-the-ground development themselves. So that's normally quite a difficult space to access bank funding with. But we've actually found those projects, you have to be selective, but we've found those projects actually to be smoother sometimes than the slightly more experienced developer, in that the clients tend to have done their diligence to the extreme. They tend to have, really invested in the right professional teams around them. So we find interacting with the clients, we can support those which wouldn't necessarily meet the experience threshold maybe of a bank. But so HMO conversions, subdivision into multiple flats, that's sort of our bread and butter.
Regionally, sorry if you don't mind me.
No, we're happy to lend nationwide. We don't lend north of the border in Scotland due to kind of the different legal system.
Yes.
But we don't have any geographic restrictions per se. Tend to being kind of around the block a little bit as a lender, tend to be a little bit cautious around properties or things that are just too specialist and too niche. Quite often that can be very remote locations, and history's taught me that you can lend to what would historically be quite a low loan to value on a property, and people think, it's a very conservative loan to value. But if the asset itself isn't very liquid and has no market, it doesn't matter what value your loan to value you're at if you can't sell the property. So that would preclude us probably from lending into too remote locations.
So just one single exit, whereas obviously ideally a number of exits because of.
Yeah, I think generally as a lender, I think leverage in some ways, I think you can do higher leverage in a lower risk way than actually you can sometimes kid yourself that you're a low LTV so this is fine. Well, actually, I think it's actually a riskier lend than doing up the risk curve, but on a on a liquid asset in the right location with the right profile, where there's multiple options for that
Yes.
property, is actually different. So I think sometimes our market can be a little bit simplistic in how it looks at risk. But fundamentally, there's always a look through to the collateral of a property as a lender, and all things being equal, the lower you are against the end value, then the safer. But that isn't always the case.
Obviously, we've now in 2024 and 16 years on, I think, if my arithmetic serves me correct, from the financial crisis of 2008. And I remember sitting at the Property Investor Show on a panel when things were going badly, and looking at looking at mobile phones and hearing the latest thing about another major bank was all not doing so well. So that then precipitated, obviously, a dramatic change in the interest rate environment, which went on for many years. So, and then of course we had Brexit, and then of course 4 years ago we had the pandemic, and so we've seen the sort of roller coaster of interest rates. So, what are your thoughts around what we've been seeing there and the implications for developers?
Yeah, it's been I think an incredible period in our history, hasn't it? Really, I think if you do think about those seismic events, but the general financial crisis, clearly I think shaped me the most because we'd built a business that was dependent upon the financial markets, and ultimately was finished overnight because the markets had closed. And then obviously that led to a really challenging period in the wider economy for people, but ironically kind of precipitated a golden age really for property investing, because obviously we moved to almost zero interest rates overnight, and had a prolonged period, decade or so of almost zero interest costs, which are incredible. And I think obviously we'll move on to sort of the challenges with inflation and kind of where we are today. But I always remember building kind of Shawbrook in the early periods. I remember explicitly talking to the Bank of England a few times about the asset class, and they were quite right in saying that buy-to-let has not had a stress. The crisis has been good for buy-to-let.
A good crisis.
Yeah, ultimately it's sort of a few factors it drove. Clearly, landlords benefited from lower interest costs. At the same time, rents went up materially because in response to lax lending standards in the owner-occupied market, it became much harder to access mortgage finance. And you can argue whether that's kind of, I would suggest, like most of history, we tend to overdo things to extremes. And there's definitely a case that we did there in terms of the stresses and the challenges facing people getting owner-occupied mortgages drove the rental market. So landlords were benefiting from that. And I think that was it really was a golden age, I think, for investors, and probably went on for so long that it was easy to forget some of the realities of that business with a higher rate environment. And then Brexit kind of came about, and I remember clearly the impact of that, which probably continued this period of like fuel for our markets and for property investors, because it kept interest rates low. We were still in Europe, so we had sort of some benefits from that, even though we were going to be exiting. So I think that kept the rate environment low. And then obviously a pandemic, which again continued that sort of trend with interest rates in particular. I think obviously the other elements to sort of the sort of pandemic did lead to some quite volatile and overdone reactions, which again I think is human nature. I think someone said if you understand economics, you need to understand human psychology. And obviously everyone now wants to live in the countryside. City centres are no-go zones, so we'll fly away from city centre locations and we'll live in the country because that's the thing to do now. And we'll overpay to do that, I mean, it's incredible if you think we're living through almost the biggest depression in our economic history, albeit the government paid for it, and house prices went up 20%. It is farcical.
Well, that's what happens when you throw $500 billion in out there.
Yeah, and obviously we're now living with the consequences, and have done for the last sort of 18 months or so, really, the realities of that fiscal policy and monetary policy. But yeah, so, and then if you think about the other kind of consequences of COVID, obviously you start to see the impact that had on construction sites, on people bringing forward projects, obviously the costs associated with manufacturing and build costs, and the supply side shocks were enormous.
Yes.
And you know, the economic realities all of a sudden of doing projects were frightening in terms of what it's going to cost to deliver, and then what it's going to cost to finance, if you could access the finance. Because obviously in the early periods of COVID, again, lenders' reactions
Understandably.
become very risk averse and very cautious.
Well, they've got shareholders to account to.
And
Wholesale lending.
and I think when you're in a crisis, it's always easy after to say, well, actually, you can see through that. But when you're in a crisis, it's hard to have the courage sometimes that you should have.
Hindsight's a wonderful thing.
Yeah, absolutely. And then I think, obviously more recently, we're now dealing with the sort of aftermath of that golden period, really. And I think some of the consequences of that, clearly, I think it was very easy to be kind of a property investor and for the economics to be attractive and to make money. I think it suckered people in to sort of false realities. And when it's been that long as a period, I mean, it's almost, that's generational, but it's getting
14 years.
It's getting to the time where people have not known a different rate environment. So in that context, you can see why people forget that it was, an ultra unusual period, and what does the model look like when you get to a more normalized interest rate environment? Now, obviously, I think the regulatory stuff around stressing interest rates and so forth has protected people to a degree. But landlords have had to now look at life through a different lens.
Absolutely.
With the additional challenges of obviously the change in the tax regime, which again was an enormous event, announced in 2017, because I always remember it being announced by George Osborne and then getting a phone call, because we were a public company at that point, saying all the analysts want to know, what does it mean for buy-to-let? It's like, well, need to think about it first, because it took some understanding, really.
Yes.
And obviously
because it was phased in over that 4 year period.
Phased. Actually, what did it mean? And what were the consequences of it? Were they fully understood by the government at the time? I would argue they probably weren't. And the knock-on consequences of effectively including turnover in a landlord's self-assessment meant
tax
that
on turnover
it's retrospective. When the reality, because landlords had already acquired properties in their own name. I think when you change the tax regime, I think one of the golden rules is you can't do retrospective changes. It shakes everyone's confidence in the system, and ultimately that's what we got.
Yeah, people built business over decades, and all of a sudden,
61% of the private rented sector's held by landlords with one or two properties, and 90% of it is in individual names. So now obviously that's shifted and changed, because I think this is just a general change in the composition of investors generally. So when you add that on top of the taper running out just as interest rates kind of rebase themselves, and you could argue that we've probably sort of a few missteps led to that rate kind of environment and rate shock being more significant than it needed to be.
Yeah. Well, we've gone from sub 2% 5 year to 5.5. I mean, I just literally saw yesterday, I think TMW around 4% with a 3% fee on a 5 year buy to let, which starts to, on a 65% loan to value. I don't know what the criteria around that might be or might not, but and how much appetite they've got.
Yeah.
As always with these things, it's a moving feast.
Yeah, and ultimately, I think it's clearly brought pressure in the market for investors to think differently, I guess, and the flight to yield
Yes.
as a result. And
Yes.
yeah, we do sometimes just think you need to think about, when you're chasing yield or when you're being presented opportunities and ideas and strategies, you've got to think about them through thoroughly and not just be kind of focused on the yield, thinking, well, actually this will work now from a financing point of view, but is it sustainable? Is it, what are the other consequences for longer term asset values in that area if the yield's so high?
Yes.
So yeah, I think that's a danger now that people are so fixated on trying to make the economics work that you kind of just are chasing yield, and you need to be balanced with that.
So yeah, I mean, I'm just thinking back over the 08, 09, and obviously we saw from about 2010, and obviously Shawbrook capitalised on that with that move into higher yield sources of income from investor landlords, small scale developers doing HMOs, etc., chasing the yield, and of course as yield suppression, capital values rose, perhaps rents didn't rise accordingly. The marketplace became ever more competitive in the 2010s going through, and of late, obviously, with the tax consequences of the Section 24, people looking at alternatives, and the holiday let market, service accommodation, short lets, the tax advantages up until very recently, and that's now changed, of course, as well, hasn't it?
Yes, I mean, I think, I'm generally nervous a little bit about some of these kind of emerging areas that get promoted.
Yes.
I guess because I come from a lending background, so I'm always thinking about it. Well, let's understand it properly. Is it sustainable?
Yes.
Is there, a good case for that strategy to sort of work in the long term, not just as a knee-jerk reaction to something that maybe has happened, whether it's a sort of the interest rate shifts. And to be honest, when we looked at HMOs deeply in the early period of the Shawbrook business, we spent ages agonizing. Say agonizing is probably dramatic, but thinking a lot about that as an asset class, because it was a hybrid in that, it has attributes that are a little bit more like commercial property than residential in terms of, these assets are really a function of their income. And therefore you have to value it on the basis of its sustainable income and what yield would an investor buy that income off, and that's how you really have to value HMOs ultimately, and that's how you value commercial property. Very different to resi property, where it's comparable based and square foot, and this one looks like that one, and this one sold recently, so therefore that's my comparable value. That's what it's worth. It doesn't work like that in commercial valuations. So even though it's a residential asset, and often it's a standard residential asset that's been converted and optimized for income, what's the right way to value that property? And I remember vividly having a seminar with valuers in the city in the early period of probably 2012, 2013. And we'd had a round session and said, look, what's the right way to value these assets? And sitting there, we had all these different valuers with such different opinions of how to do it. Frighteningly so as a lender, because you're like, well, actually, if I'm lending on a HMO in this part of the country, it's going to get valued one way. If I'm lending on it in a different part, it's going to look quite different, and that's quite sort of scary, really, as a lender. So we spent a long time thinking about it, and then we started to try to segment the market into kind of small HMOs, which, to be honest, are quite easily created, and there's no scarcity to it. And then obviously with the Article 4 introductions, and then a scarcity to it, and the emergence of purpose-built property, which isn't really a family dwelling anymore, can't be used as a family dwelling anymore. Its only buyer is an investor.
Mm-hmm.
And therefore the question comes back to, what will the investor pay for that income? Now, the quality of the income, so, its location, the quality of the accommodation, all those kind of factors. And then you start thinking about, the over 6 beds and the sort of 12 and the 13, and, you're getting into almost smaller kind of accommodation, smaller guest house type size properties. But it's a sector that we're very bullish on and believe in fundamentally, and I think it plays strongly into the demographics today of recent students, graduates, key workers, young professionals. That demographic want
Mobility.
Yeah, absolutely. They want ease. So they want, it needs to be as cost effective. I think people would sooner live in a nicer area but have smaller short smaller accommodation, but in the right area, more affordable, so that they can enjoy all the other experiences of life, which is that generation's. And yeah, I think the flexibility of it, I think it's an asset class that will sustain, and I think it forms an important part of housing tenure. It's clearly for a period of time in people's lives and in our population. It's not clearly for everyone. I then worry about kind of some of these newer areas, about do they have the same fundamental sustainability really, and I'm not sure that's the case.
So short let
part hotel, service accommodation, it's all these kind of anything that can generate more income or perceived to generate more income, but people just need to think about, well, is that sustainable? Is it genuine? Because for it to be genuine, it needs a mortgage market and a debt market that will provide long-term funding on, and people need to understand the valuation at which that's going to be done at. And I think with HMOs now, there is a much better understanding of a lender's approach and the type of yields, whether it's going to be a yield-based valuation or whether it's going to be on a manufacturing basis. Whereas I think in some of the short-let accommodation sector, I'm not sure there's clarity there of how lenders look at that.
Well, it was certainly exposed in the first year or so of COVID, wasn't it? With the retreat, obviously, from cities for business travellers staying in which had been booming for a few years.
Yeah, I have a kind of few principles I think that I've taken from my career. One of them is like contrarian. You hear Warren Buffett talk about contrarian investing, and obviously an incredible person.
Yes.
But the principles of contrarianism, I think, are actually valid in human nature, in that we just go from extreme to extreme. So I think there's almost a starting point should be whatever extreme we've ended up at, then we should be in the other place because we've overdone it. So COVID, I think, is a classic, and working from homes again, the death of city centres, the death of London, the death of, all these things get sensationalised, and the reality is things are shifting, but they're not moving from one edge of the spectrum to the other. There's a move within it, and I think if you can try and find a more balanced mindset in those periods, I think you can do very well. And I don't think the working from home phenomenon is quite what everyone thinks it's going to be.
I came in today by train, and my local station car park, which 2 years ago was tumbleweed, now virtually full. It's just a sign of the time. It's obviously we're here down in the city in central London, and there's a lot of activity now. Much feels pretty much, I wouldn't say completely back to where it was. No. It's not, but it's a lot more vibrant than it was 2 years ago, 2.5 years ago. That's for sure. Yeah,
definitely. And obviously, I think when you get change, you get opportunities. So there's obviously the recent changes with permitted development, which now I think has been just recently changed again, where you've got opportunities to convert Class E properties. So there is. I think we'll recall the first wave of the office to residential conversion.
Yes, 2013,
journey.
2014.
Yeah, the kind of initial, early adopters, which I think we'll all look back on and realise that, obviously some schemes were delivered very well, others delivered poor accommodation, ultimately the slums of the future. And obviously that's been through some standards and things have changed. And now we may get a second wave, because the reality is you do have the rights, obviously under I think the Class OM now, of converting Class E properties to residential, and they've removed some of the restrictions. So previously it could only be 1,500.
That's right. Yes.
It had to be 3 months vacant. So that's now been removed. And if you look at the values of secondary commercial property, they've fallen significantly, down 20-25%. Residential values obviously had the lift through COVID, and then despite the economic environment have stayed stable. So now there's kind of there's quite a significant value uplift achievable, I think, from conversion of some of those commercial assets to residential. And that may well be the catalyst for the second wave, I think. And so that's going to be more likely to be driven by that value opportunity rather than, I think, the first wave, which was, slightly ill-considered in some cases.
Yes, that 2013, 24 rush to the trough, so to speak.
Yeah.
And you say standards were not
Yeah.
as now in hindsight, looking back, as rigid as perhaps they could have been.
But I think
too lax.
Yeah, but I think I was reading something the other day that I think last year, 4 or 5% of the new home delivery was from permitted development conversion.
No, it's still relatively small.
Yeah, but it's the opportunities there,
Yeah,
I think, and I guess in the environment that we're in now, where everything's harder, you've got to work harder, I think, to find things that can work. And as much as we can argue that the politics of the day and the period, and it's targeting really, I guess, of the professional and the private landlord, and whilst it's popular, it's clearly unpleasant for investors, isn't going to change no matter how much we might argue that it's not fair, or how much we might lobby, or how much good work the NRLA might do. It's here to stay, really. So I think we all need to shift our mindset into working within that environment rather than trying to change it.
The old adage of the going's got tough, and the tough have got to get going, and work smarter, work harder.
Yeah, and I think you just have to accept realities, don't you? I mean, the brutal truth of it is you just have to accept the market you're in, rather than rail against it, and then find ways to make it work. And there are still ways to make it work, and there are tailwinds for investors and developers. If you just look a few things that sort of strike me, you've got nearly 10 million people more in the next 10 years coming into the country through obviously economic immigration and then just the demographics of our population. So you've got, I think, an exodus, I suspect, and a continual flight from the sector, from smaller private landlords who, it worked, but now it doesn't work.
Yeah, the demographics of landlordism, obviously, my generation, I think we talked previously about this, that and understandably people get to that certain stage and okay, it's just had enough, or as you'd say, and which brings in and people with more vigor, with more technology also playing a part in this, the tools that are now available for people for site finding and sourcing deals, etc.
Yeah, I think you've obviously got institutional capital coming into our markets in, the build to rent and the purpose-built student accommodation blocks, and that's been happening for some time and will continue to happen, but it's a fraction.
It is
of the rented household population. I think I saw some data. I think 90% of it's in the 90,000 of the 5 million households are in the build to rent sector. Which means the rest of it's in the private landlord sector.
It's a relative drop in the ocean. I mean, we just covered that in an article in the magazine. Just this fallacy around,
Yeah,
this
it's the
wall
answer.
of build to
Yeah.
rent coming in the next year or two.
Yeah.
It's
Yeah, it does
Yeah.
disservice to the role of
Mm.
private landlords and smaller SME professional
Mm.
investors. It really does. But it's interesting also, though, when you look at those models and obviously the co-living, I think about the co-living kind of
I was going to
concept.
touch on that. Yes.
And then how does that read across to HMOs really, which
Mm.
is the market that we serve
Mhm.
primarily, and our, it's rare that we're going to see clients do the big schemes with the institutional money, but can you look at those projects and can you learn from them, and are there elements of those that you can transpose to HMOs and to make the HMO market or your product better? And I wonder whether there's opportunities there for investors. Clearly they're not going to be building cinemas or gyms
No.
in their HMOs, but can you take an element of those services that are provided in that co-living kind of product and apply it to the HMOs, whether it's with partnerships with local service providers? There's clearly a compelling case for co-living, and if you think about it, a lot of those fundamentals apply to HMOs as well, i.e. flexibility, affordability, locations that otherwise you couldn't afford to live in. Well, that's the case with HMOs. A lot of the people that are using that accommodation, they're using it on a shorter period because they can't afford a one-bedroom flat or a studio flat, or if they could, it would be in an area they don't want to live in.
Quite.
That's why I've kind of remained bullish on sort of the house share and the HMO market. It clearly has the benefit of an income profile that can support the debt levels that we're likely to live with now. So we're recording this, we're at 5.25, and every day someone's guessing another number, right? But we are moving in a direction where they're gonna fall. Where do they settle? No one really knows. Kind of most commentators and most forecasters are around the 3.5 level for a base rate. When will it get there? Who knows? But that's probably the outlook. Then if you're adding on like a lender's margin on top of that, therefore you're probably getting into the sort of mid fives, high fives as a sustainable kind of finance rate. So when you look at it like that, then the yields that you need to make that work on a leverage basis here obviously are higher. And HMOs will always have that in their favour. Ultimately, they'll be able to work efficiently and on a leverage basis. Not true of single family dwellings and single lets.
It's a long-term hold. Yeah. No, I did an interview yesterday with someone that's going to be in the magazine in a month or two's time, and she very specifically said, well, I'm able to make this work now on this project after an awful lot of diligence to arrive at the project that almost completed. And if I can make it work on these numbers, then if rate comes down from 5.25 down to 3.25, 3.5 or whatever, in a few years' time, obviously, with rents rising as well, likely to be because of the shortage of supply relative to the increasing ongoing demand, then that's going to be a pretty positive project.
Yeah. And I think, most people are genuinely investing for the long term. So you do need to look through periods of volatility if you can. Not everyone's fortunate enough to be able to do that. And I think when you have investments that were cash generative are now providing kind of a shortfall and you have to actually subsidize them, that's quite a psychological difference. Even though you're believing in the long term, this asset may appreciate in value, when you're having to put your hand in your pocket to subsidize the model, I think that can drive behaviors and obviously has done in terms of people deciding enough's enough and I'll take my profit and find another way. I mean, if I think the IMLA data last year, I think they had the return on investment of 3.75, I think was the average in the buy-to-let sector. But at that point, the risk-free rate of returns 5.25.
Right.
So obviously you can put the money in the bank and you've got no risk.
Quite.
Now that's a point in time. So obviously that 5.25 isn't gonna last, and that will start to fall away. But if that is your risk-free rate of return, and the average in the sector is 3.8, it doesn't take a rocket science to work out that all of a sudden you're going to have other opportunities for your capital, which all of a sudden will probably be more attractive than buy to let. Certainly, if you've bought low yielding assets in your personal name and the tax treatment's penal.
People still coming into this market, still creating HMOs, co-living, and advice to people coming into the market today about funding HMOs and stuff that they've got to think about.
Yeah, I think number one would be the finance viability. There's no end of people telling you that, you can manufacture this asset and it'll be worth X. But really, it's the important thing is, what is the mortgage market's approach to that? Will it value it on the same basis? And being confident and maybe sensitizing your assumptions. So, a number of our clients would be very knowledgeable about the yields in their area for HMOs, and there'd be evidence for that. And then they would, when they're sort of stacking a deal, they would say, well, okay, let's assume the yield moved out 100 basis points, 150 basis points. Does it still make sense? I think those kind of sensitivities are very helpful, because you need to, once you've completed the project, to be able to access kind of the right level of funding against the end value, really. Otherwise it becomes inefficient and you have too much capital kind of tied up. So just being very sensible about the end values and the viability of the financing, and who are the lenders that are using a yield-based approach to the valuation. Is it a small group or are there more of them? And apply some sensitivities to it, just in case the market moves. So obviously, when we saw interest rates move dramatically, the yield that an investor demands to buy a HMO moves as well, because they can get a better return for their capital elsewhere. So you do get yield volatility, and I think making sure you thought about that is important. I think the other thing that I've seen sometimes is clients looking to optimize the property midway through a project, or being kind of seduced by the fact that we can maybe get another room, we can kind of make it a bit bigger. And I've often seen that lead to quite material delays and cost implications for clients, and they can seriously outweigh the benefit of potentially a slightly bigger asset or more rental income. So try not to get seduced, I think, by any of the professionals saying, oh, actually we can optimize this a bit more, and open the can of worms again with planning. And the other thing that we've seen sometimes is investors, whether they're using sources or other professionals, doing it in areas that they're not close to and they don't have good oversight to. And we've seen a few clients, very good clients, who I think have been unlucky in they've been let down a little bit by their professional team. And because you're not there all the time, you can be taken advantage of. So I think thinking about the geography, making sure you've got a team that have got experience of HMOs, not just other forms of construction and projects, is a factor.
No, when people are 3 or 4 hours away from where they're at on a normal day-to-day basis, their home, their place of work, but they're putting together a project, 200, 300 miles away or wherever. Obviously, that's additional risk. That's has to be factored in terms of.
We've seen that. We have seen that, and we, whilst it proves problematic because we're kind of funding the project, you do feel for the client, because it's not possible for them to be there on site driving, and they're taken advantage of really because of the geographic remoteness. So
and of course, as the yield shift, it occurred in 08, 09. And then of course it's been occurring in recent years as well, as people would looking for a greater return because of the increased cost of monthly debt relative to the mortgage payment, because of bank rate going from not a lot to a fair bit more than not a lot.
That's right. And it's just making sure you're not being seduced by a yield. And make sure you're thinking through all the other aspects of that project really, and the long-term aspects.
So the segments within HMOs, just as something else maybe to touch upon, obviously student-let market, I think you mentioned earlier about the growth in the purpose-built student accommodation market, and then of course the more recent offshoot of that, the build-to-rent sector. But student-let properties, obviously during COVID, some of that sector had a obviously problem, particularly international students. So thoughts on the student HMO market and your experience?
Yeah, I think with all build to rent and the purpose built student accommodation, that they're here to stay.
Yes.
They have a role to play in the market.
Mm-hmm.
And again, landlords, I think, just need to be mindful of it, really. I don't think it's the panacea. Most students don't actually want to live in any, a large property. It can be soulless. The experience of having a house share, I think, is still attractive, certainly to domestic students, certainly undergraduates and and postgraduates. But the purpose-built accommodation is a part of the market and the fabric of the market. I think understanding the supply in your area, the price point of that, I'm still a firm believer that the demand side for students continues to be outstripping the supply. I think the product's different, but it's obviously going to provide competition. And I think you just got to be alive to the price point, really, and the relative competitiveness of your product versus that.
Obviously, anecdotally, but a typical private sector HMO room could be 25% cheaper than a PBSA product.
Yeah.
So and also, as you say, the advantages that are perceived advantages by students in their second year, having lived in halls in the first year, etc., wanting to be with their friends in that 5-6 bed accommodation, socialising together, etc., etc.
Yeah, but I think for the HMO landlord, I think having an eye to risk management, fine. So if there's a challenge in the student sector, what's my other tenant opportunities? Do I believe in the local key worker demand? Do I believe in the postgraduate young professional? Can I attract those tenant groups into my asset? And have I got the right type of property to attract them as well as students? So I think just general rule of risk management is to try and hedge where you can and have some optionality. And I think the clients that we see, they normally have a very clear tenant profile in mind, but they also have an eye to, if that's not there or if that's stressed, can this work for others? And I think that's helpful.
Yeah, so having that alternate exit 1, 2 or 3 potentials should things not quite go to plan or something comes along, as I said, 2021 with international students deserting the UK in droves, etc., etc.
Yeah, and I think the other rule generally in my experience is if you've got good properties in good locations, even when the market gets tougher, you're still likely to do okay.
Yes.
But if you've got poor quality property in the wrong location, it's the first part that's going to suffer. So, you've got to get your quality right, I think. And that also provides you, I think, some resilience against, maybe the threat from purpose-built accommodation as well.
I mean, PBSA products, some of them built in not so good locations, and they have suffered over a number of years through may well appear good on paper, but unfortunately the students and their parents vote with their feet if they realise that everything that they want on a day-to-day basis is further away than they'd realised, or the difficulties in terms of buses or whatever. Just moving on to talking about we've mentioned already the tax regime, the way that's changed in the last 8 years, but of course we've got a number of other potential challenges for the private rented sector, not just HMO landlords, not just small scale developers. With first of all, we've got the Renters Reform Bill, somehow gradually, maybe not in this Parliament, and that's going to impact, if it stands in its current form, the student market and the abolition of fixed term tenancies. So what are your thoughts around that in particular?
Yeah, and my portfolio actually serves the student market. So I think about it. I mean, it just doesn't really make sense that they can persist with something that's so obviously gonna unsettle a key tenant group.
Yes.
I mean, the whole point is looking after tenants' rights, and it just seems maddening to me that there wouldn't be an appropriate concession and thought to the realities of
Mm.
students and
Mhm.
term, term timetables. So I just can't believe there won't be some common sense applied. And if it isn't, then look, I'm sure we'll find a way.
Mm.
There'll have to be, because it just doesn't suit the needs
No.
of that tenant group.
Well, it's
Yeah.
a significant part of our economy.
Yeah.
International students, sector that I worked in decades ago, it provides billions for the UK and hundreds of thousands of jobs. So to literally pull the carpet or the rug from underneath by making it so insecure a proposition for creating. Yeah.
But I can't believe for 1 minute that there won't be some accommodation for it, because there's such a supply-demand imbalance
Yes,
already.
indeed.
We've already seen the impact of rent controls in north of the border, and all these government interventions, which most of the time most economists will tell you any government intervention normally ends out in poor outcomes.
Yep.
And that's clearly been the case with rent reforms and rent controls. Just hopefully, they'll realise that that it's an important sector and you need to recognise the needs of those tenants. That's the whole point of the Renters Reform Bill.
Yes.
So, fingers crossed we get some common sense.
Article 4, that's another.
Yeah.
And licensing,
Yeah.
this is also being increasing, obviously with cash-strapped councils looking for as much revenue they can and seeing landlords as low-hanging fruit in order to extract. And not necessarily, there's some councils that actually are good enforcement and are genuinely putting into play the proceeds of the revenues that they're bringing in for licensing, but there are other councils that are not. It's just going into wherever it goes.
I actually look at this a bit differently. I think Article 4 is generally good for investors.
Yes.
In that it makes it harder, and you've got to think about it, and you've got to invest and work the system, understand where the opportunity is or where the demand is. I mean, certainly, the hotspot points for HMOs, investing a bit of time understanding what the local authority wants, build a relationship with them, and actually you can design the product that they want, and it's harder for other people to kind of compete with you, because it's just not easy. You just don't turn up and just buy any property and just convert it. So actually I think the Article 4 kind of directives provide opportunities for those investors that are put the time and effort in to build the relationships with the local authorities, understand what they're looking for, where they're looking for, and there should be barriers really for other investors that haven't put that homework in. So I see that as an opportunity actually, and a lot of the clients that I'm thinking of know it inside out and back to front, and are often acquiring assets, and they're extremely confident around the planning outlook for it. I think investing the time to understand and building relationships, I think, can pay dividends actually with Article 4 councils.
And just talking about investing in sort of the HMO and sort of mixed use, and there's trends that we're seeing based on your experiences over almost 2 decades now. What are the common mistakes that you see people make that obviously we're in, perhaps as you say, less forgiving times now, but what should people be absolutely be wary of not doing?
I think the number one rule is never to overpay. I think you can't really recover from that. I think if you can acquire an asset you think at good value and there are opportunities with it, it can make up for a lot of bumps in the road and things that don't go your way, and they do. I mean, in a project, there are no end of problems that you foresee and no end of problems that you don't foresee that come around and make life difficult for you. That's part and parcel of property investing and property developing. The people that I've seen that have come most unstuck are those that have over borrowed, over leveraged, pushed themselves too much on the way in, overpaid for a property, hoping that everything's going to go perfectly. So I think the key is being disciplined when you're buying, not pushing yourself because you feel you need to do a project, or you're kind of getting impatient. I think you have to be just disciplined about the fundamentals of the project on the way in, and it needs to have margin in it because things can and do go wrong.
Yes.
And you can't recover if you've overpaid on the way in. So I think when there's good upside, you can live with optionality on what you might want to deliver because there's lots of room. But don't take on too much debt too early at the wrong price because it's almost impossible to recover from that.
Yeah, well, it's a time and time game since been publishing Property Invest and Use, that people just being over optimistic, people stretching that elastic band of optimism, and then unfortunately they crash and burn when the first bump in the road comes along.
We've all done it. You can play around with the assumptions in the spreadsheet, and you can kid yourself. And I think that my key advice would be just try to be disciplined on that point. And we've seen clients recently who've spent 18 months very frustrated because everything that they've looked at just doesn't work anymore. Combination of obviously the land prices or the original property prices, which is normally the last thing to adjust. Obviously the new realities of finance costs. And whilst build cost inflation's come down, the costs haven't come down. It's at an elevated level. And they've been very frustrated that just nothing works. Although recently now, you've got to be patient because it will correct. These things have a relationship between them. It normally takes time for that reality to feed through to sellers of land and property to like the new realities. And it's interesting because now they're saying, they just had a conversation with me just the other day, and they're like, everything we're looking at now is starting to work. So, and I think, so be patient. Don't sort of jump in just because you feel like you need to do a project. Just make sure the fundamentals are good.
Yeah. So that's just because it's in your pocket, ready to be splashed out, and this doesn't mean it should be committed unless the numbers just work.
Yeah, discipline
with a margin of error as well.
Yeah, discipline on the way in. I think is what I would say.
So Stephen, thank you very much for your time today. It's been absolutely fascinating to hear your thoughts, and I'm sure listeners to the Property Investor News podcast will be welcoming and listening intently to what you've had to say. Some nuggets there of wisdom from your experiences in the sector over the last 2 decades. And so thank you very much for your time.
Oh, it's my pleasure. Thanks for giving me the opportunity to talk about the market. It's something, I think we're both passionate about. Obviously, the environment is tougher, I think, for investors and developers. And, you got to work hard to make it work now. And but I think it's just going to accelerate that shift to the more committed professional in the sector, and actually I see that there are opportunities in that. And in 9Y Capital, our kind of desire is to sort of be as flexible and as maybe as innovative as our clients, really. And I think you do need capital providers who can match and understand the realities of today's market, because the opportunities are there. You just need to be creative and work hard to realise them.
Thank you. So it's Richard Bowser, Property Investor News with Stephen Johnson from 9Y Capital. Thank you.